Welcome back to today's lesson. So today we want to look at capital budgeting technique focusing on net present value. Before we get into the net present value, what is capital budgeting techniques? So capital budgeting techniques are the methods used by business to evaluate and make decisions on potential investment in a long-term asset, such as construction of new equipment, facilities, or a project. These techniques help business to determine whether a proposed investment will generate a positive return and add value to the company. So that is what capital budgeting techniques is all about, right? So it is a means that a business uses to evaluate the viability and the success of undertaking a project or an investment, and to see if it can yield a positive returns in a long-term benefit or in a long-term approach. So that is the capital budgeting techniques. We have a number of budgeting techniques or capital budget techniques. We have the payback period, the discounted payback period. You have the net present value. You have the internal rate of return or the accounting rate of return. But today I want to focus on the net present value. So what is the net present value and how is it calculated? Net present value calculates what? The present value of all cash inflows and outflows associated with the investment, taking into account the time value of money. Very key thing that you want to take note of, that time value of money. Okay, so how then do we accept an investment if we are using net present value? So the rule here is that net present value should be, to accept a project or an investment using the net present value, the base rule here is that the net present value is supposed to be positive. That is the underlying rule. The investment is supposed to be considered as profitable. So once it's positive or is greater than zero or equal to zero, then we are saying that in a net present value, you're supposed to accept that particular investment. So let's take note of that. So having we gotten that, let's take an example to clarify that. So if you have an example here or a question to clarify the net present value, this is how it goes. Mami Lizzie is deciding whether to invest. So let me try to. Mami Lizzie is deciding whether to invest in a retail business. So the relevant cash flows are expected to be as follows. So we have the initial cash flow, which is the investment, that the total cost of the investment, okay, in terms of the original amount. And then these are the yearly cash flows associated with the year one is 20,000, year two 60, year three 30,000, year four 15,000, year five 10,000. So this is the cost of capital or the risk associated with the investment that has been estimated to be 10%. 10% cost of capital. Okay, so the question here is determine whether the project should be accepted or rejected using the following methods. But as I said in this part of the early part of this video, we are focusing on the net present value. So how then do we calculate the net present value? So this is the formula in calculating the net present value. Net present value is calculated as, so the net present value, NPV, should be equal to summation of the cash flows, the future cash flows of the investment divided by their future value factor, which is 1 plus r all to the power n, minus the initial investment, minus the initial investment, minus the initial investment. This is how we calculate the net present value. This is how we calculate the net present value. The summation of the discounted future cash flows, right, of the investment compared with the total initial investment, which in this case was what? 100,000. Right. So how then do we go by this? So with the help of our smart calculator, we can easily do this. So let's see how it goes with this. So generally, these are our cash flows for the years, and then our cost of capital has been giving us what? 10%. So to use the net present value as you have calculated as a formula here, right? Then we can bring in these values to help us to go. So we know that year one is 20,000. So we'll have what? We will have 20,000 coming up, okay, divided by 1 plus. So our cost of capital is what? 10%. So that is what we can say that here comes the same thing as 1.1 to the power what? 1. But that's the first startup. Then we have what? We follow the same rule to do the calculation. We have the next year 2 to be what? 60,000, okay, divided by what? 1.1 to the power 2. Then follow the same thing plus. Since we are doing a summation of for the discounted future cash flow, that's how we go by that. Then year 3, we have 30,000. So divided by in bracket 1.1 to the power what? 3. Then we have year 4. Here we have what? 15,000 divided by 1.1 to the power what? 4. Then year 5 being the last year, we have what? 10,000, all right, divided by 1.1 or to the power what? 5. So once we have this, okay, we can bring in a full bracket coming up there. We also have this coming up, we can close that, and then minus. So what was the initial investment? That was what? 10,000 here. Or we can see that 10,000 here. Okay, so we subtract that from, I said 10,000, 100,000 generally. Okay, it is 100,000. So we have what? How many zeros? 5 zeros. So when we do that, for us to accept the investment, we are saying that it's supposed to give us what? A positive what? NPV. So let's see the result. So here we are getting what? A result of what? 6,700 and what? 62.45. So in current, so we have our net present value then. Our net present value to be equal to what? So here it was given in Ghana shillings, so we have what? 6,000. So let's see the calculation. 6,762 point what? 45. 762.45. And that means that we will then accept what? The investment that Mamilizi is deciding to invest in a retail business. So let's take note of that. And that brings us to the end of what? Our discussion on the net present value calculation. Thank you for watching. If you find this video helpful, do all to subscribe, like, and share the video so others also get the benefit to always to join us. Thank you, and I'll see you in the section where we discuss other capital budgeting techniques. Bye bye.